Imagine a town where the most valuable asset isn't the steel rolling out of the mills or the grain filling the elevators, but the tax write-off created by tearing the entire block down. If you look at a map of the United States today, you will see a strange, almost impossible paradox. The country's gross domestic product is at an all-time high, corporate profits have never been greater, and the stock market is screaming toward the stratosphere. Yet the towns that physically built this nation, the industrial heartland of Ohio, the coal valleys of Pennsylvania, the manufacturing hubs of Michigan, are visibly, physically crumbling. We have been told for decades by economists and politicians that this is simply the natural evolution of a globalized world, a necessary side effect of progress, and the inevitable shift toward a service-based economy. But if that were true, the immense wealth created by that progress would be visible in your local school budgets, your city's infrastructure, and your family's savings account. Instead, it is gone. This is not a story about the good old days or a nostalgic trip into the 1950s. This is a cold, clinical financial audit of a missing fortune. Today, we are going to answer one specific question that haunts every boarded-up Main Street. Where, physically, did the trillions of dollars produced by the American heartland disappear to? If you want to understand why you can't afford a house in the same town where your father bought one on a single blue-collar income, you need to stop looking at politics and start looking at the machinery. We are going to reveal the specific financial mechanics that turned your community from a productive center of life into a harvestable, disposable asset. To find the missing money, we have to start our audit at the primary source, the local factory. For generations, a plant in a small town was the sun around which the entire community orbited. It wasn't just a place of employment, it was the primary source of the town's liquidity. The factory paid the taxes for the parks, the police, and the libraries. But in the 1980s, a new financial predator arrived on the scene with a tool called the leveraged buyout, or LBO. To understand the hollow, you must understand this mechanism. Stripped of the Wall Street jargon, an LBO works like this. An investment firm from New York decides to buy a healthy, profitable tool and die plant in the Midwest. However, they don't use their own capital to buy it. They take out a massive loan to purchase the company, and then, here is the pivot, they immediately pin that debt onto the balance sheet of the company they just bought. Imagine buying a house, but forcing the house itself to pay off its own mortgage while you sell the furniture on the lawn. This is our first mini payoff. The wealth of these towns didn't vanish because of bad trade deals with China. It was converted into interest payments. The factory wasn't closed because it was failing to produce a good product. It was closed because it had been turned into a giant high-interest credit card for a firm thousands of miles away. By the time the plant is shuttered and the jobs are gone, the investment firm has already walked away with hundreds of millions in management fees and special dividends, leaving the town to deal with the toxic bankruptcy. The money moved from the production floor to a ledger in Lower Manhattan before a single machine even stopped humming. But the extraction process did not stop at the factory gate. Once the stable jobs were eliminated, the financial machinery moved to the next logical target, the only thing the American middle class had left, their homes. For generations, the single-family house was the primary vehicle for a family to build equity and generational wealth. It was a closed economic loop. Your mortgage went to a local or regional bank, which in turn lent to local businesses, keeping the town's heart beating. But after the 2008 financial crash, a disaster manufactured by these same institutions, the rules of the game were rewritten. While millions of Americans were being evicted from their properties, mega funds like BlackRock and Blackstone realized that owning residential property was significantly more profitable than selling it. They deployed sophisticated high-speed algorithms to outbid local families for thousands of starter homes, often making all-cash offers within seconds of a listing appearing on the market. Why? Because the new goal of the American economy isn't ownership. It is permanent, non-negotiable subscription. This is the second step in our audit. Your monthly rent isn't building your family's wealth anymore. It is being bundled into a rental-backed security and traded as a yield-bearing instrument on a global exchange. The money that used to stay in your zip code is now being vacuumed out and deposited into digital vaults in tax-neutral havens. You are no longer living in a neighborhood. You are living inside a diversified portfolio for a hedge fund. The hollow isn't an absence of money. It is a violent redirection of it. As the audit continues, we find that even the basic survival of the population has been financialized and monetized. When the factories left, they didn't just leave behind empty brick shells. They left behind a vacuum of purpose and a landscape of economic trauma. In that vacuum, a new and darker industry emerged: the monetization of human pain. It is no coincidence, and the data confirms this, that the maps of industrial decline, the maps of the LBO raids, and the maps of the opioid crisis are almost identical. Pharmaceutical companies, driven by the exact same shareholder primacy as the private equity firms, flooded these distressed markets with highly addictive painkillers. They didn't see patients in need. They saw a market of pain that could be scaled for quarterly growth. This represents the third stage of extraction. Every prescription filled in a dying town was a transfer of the last bits of local wealth, often through government-subsidized Medicaid or Medicare, back to the balance sheets of massive corporations. They weren't just treating a health crisis. They were harvesting the social fallout of the industrial collapse they helped engineer. This is the double extraction. First, they take your job. Then they sell you the chemical numbing agent required to endure the loss of that job. This brings us to the final, most sophisticated stage of our audit: the transition to the subscription economy. If Wall Street has already harvested your workplace, your home, and your health, what is left to take? The answer is your daily life itself. You have likely noticed that you don't truly own anything anymore. You have a membership for your software, your music, your movies, and increasingly, even the hardware you use. Car manufacturers are now experimenting with charging monthly fees to access the heated seats or the navigation systems already built into the vehicle you purchased. This is the asset-light model. Corporations have realized that selling you a product once is a major financial mistake because it ends the relationship. It is far more lucrative to own the product themselves and charge you a usage tax to access it every single month for the rest of your life. This is the hollow state in its final, perfected form. Every action you take, driving to a job you don't own, in a car you don't own, to go back to a home you don't own, sends a small, permanent stream of capital back to the same handful of institutions. The wealth of Middle America didn't evaporate into thin air. It changed state from solid to liquid. It moved from the tangible world of property, deeds, and production to the intangible world of fees, interest, and digital rights management. The great biting irony of modern America is that while these towns were dying, the economy, as measured by the stock market, was reaching all-time highs. This is the ultimate decoupling of a nation from its people. We have created a system where the economy thrives specifically because the community is decaying. In the eyes of an analyst on a 43rd floor office in New York, a flexible labor market, which really means a defenseless, ununionized labor market, is a massive boon for stock prices. Higher rent prices, though they crush the middle class and prevent young people from starting families, are a guaranteed win for the institutional landlord. We are told that efficiency is the ultimate good, but we never ask who that efficiency serves. If it is efficient to destroy a town of 50,000 people to add 3 cents to a share price, then our definition of efficiency has become sociopathic. We have replaced the general welfare mentioned in our Constitution with the quarterly earnings report, and we are acting surprised that the social fabric of the country is tearing itself apart. The hollow is the empty space where our social contract used to be. It is the gap between a citizen and a customer. To see the final payoff of this investigation, we have to visualize the map of extraction. Imagine your town not as a collection of buildings and people, but as a grid of sensors in a giant national machine. Every time a private equity firm shuts down a local factory to pay off its own debt, a sensor turns red. Every time a global fund outbids a local family for a starter home, another sensor turns red. Every time you pay a recurring monthly fee for a service that used to be a one-time purchase, a red line of light leaves your town. If we pull back the camera to a satellite view, we can see millions of these lines from every small town across the Midwest, the Rust Belt, and the South, weaving together into a massive, glowing cable of energy. That cable doesn't go to China, and it doesn't go to Mexico. It leads directly into a handful of high-frequency trading servers in Lower Manhattan and the server farms of Northern Virginia. That is the answer to our question. The money isn't gone. It has simply been rerouted into a new system that doesn't require your town to be healthy in order to function. You are no longer the owner of the American dream. You are a temporary biological host for someone else's capital. The hollowing out of the heartland was never a tragedy. It was a highly efficient 40-year transfer of title. It was the conversion of a nation of builders and owners into a nation of debtors and renters. The final payoff of our audit is the realization that the missing money is actually you. Your future earnings, your rent, your health, and even your very time have been packaged, securitized, sold, and traded before you even wake up in the morning. This is the reality of the 21st century economy. You aren't a citizen of a community, you are a user in a global subscription service, and the terms of your contract were written by the people who now own the street you live on. The audit is complete. The money was never lost, it was harvested. The hollowed-out shells of Ohio and Pennsylvania are not the result of a failing system, but of a system working exactly as it was designed to work. The wealth of the heartland didn't evaporate. It was liquefied and pumped out, leaving behind a husk that we still call a country. And as long as we measure the health of a nation by the height of its stock market, rather than the depth of its roots, the extraction will continue until there is nothing left to harvest but the silence of the towns we left behind. This is the ledger of the modern world. On one side, you have the factories, the homes, and the families. On the other side, you have the interest, the rent, and the dividends. For 40 years, the pen has been in the hands of the accountants, and they have been balancing the books by erasing the people. The missing money has a new home, and it's a place that doesn't care if your town has a library, or if your children have a future, or if the heart of the country ever beats again. It only cares if the interest is paid on time. And in the new American economy, the interest is always paid, even if it costs us everything. This is the conclusion of our search. The hollow is the footprint of a titan that has moved through our land, taking what it wanted and leaving the rest to rot. The only question left for the viewer is whether we are willing to keep paying the subscription fee for a dream that we no longer own. The heartland is now a harvest land, and until we stop being the crop, the extraction will never end. This is how Wall Street hollowed out Middle America, not with a bang, but with a series of perfectly legal, highly profitable, and utterly devastating financial transactions. The audit is closed, the truth is on the table, and the price of the American dream has officially become more than the American people can afford to pay.